Awesome.
Well, hello and welcome to the Homefront, Minnesota. I'm Chrissy Peterson with eXp Realty and the Chrissy J. Homes team. And I am here today with Nikki Erickson with Kevnick Mortgage. And we are just going to use this podcast to educate people out there on what's going on in the real estate world. We'll talk about mortgage. We'll talk about all things home related. But I want to introduce Nikki, and then we'll kind of get into the hot topic of the day and what everybody's buzzing about. So, Nikki, if you want to tell us a little bit about yourself and your experience, that would be awesome.
Awesome. So, hey, everyone, I'm Nikki Erickson with the Kevnick Group. We are a Minnesota local lender mortgage company that really helps clients understand and strategize with their mortgage. We are focused really on educating our clients, helping them strategize through the options that are out there. And of course, using this platform to keep everyone updated on what things are happening in the market and what we can do to help you make smart decisions about your mortgage, smart decisions about your lending, and then talk about how Chrissy and I continuously team up to be a strong team for our clients and to help them get into homes, especially in this competitive market. So we're excited to start this podcast together. So yeah, let's take it away, I guess. Yes.
I do want to note that, Nikki, they are also licensed. They can operate in all 50 states?
All 50 states. Yeah.
Okay. So if you're looking for that second home, vacation home, looking to get out of this
frozen
Minnesota with the longest winters ever, all those things. Or she does a lot with investment properties as well. So we will be talking a little bit about investment opportunities and what that looks like and how we can help in that market as well. So today I would love to, Nikki's my go-to. She is a great educator, and she is patient with all my questions, but I really love how she explains things to both myself and to my clients. And right now, I mean, it's all over social media. It's all over the news. This thing that's going on with rates and with well-qualified buyers and maybe not as well-qualified buyers. And what's going on with that, Nikki? I want you to put people's minds at ease. Obviously, media is really great about the fear factor and stirring things up and getting people worked up. And so we really have to be mindful of, all these headlines that are out there, right? They're triggering. Really, you want to be talking to a professional that can explain the facts of what's going on. And also know that, when you're working with the right people, right, the right professionals, there's going to be a good solution for your particular circumstances. So we've been talking about this for months.
Yeah, we have been.
This is not news. This is not something that just happened. We've been talking about this, and so we are already prepared and having the right conversations with our clients. So Nikki, I'm going to let you take it from here, and I may interject with some of my, silly questions, but
questions and comments. Yes, absolutely. Things that you've heard. So the big news in the media right now is the headlines say it all over the place. Fannie and Freddie are raising interest rates for well-qualified buyers, and they are lowering interest rates for not so well-qualified buyers. And there is actually some truth to that. So anytime in the lending world, when we use investors like Fannie Mae and Freddie Mac to lend on mortgage loans, we have what are called LLPAs, or loan level price adjustments. When we have these LLPAs, they are based on credit score, they are based on percentage of money down, and sometimes even debt to income ratios. Sometimes even where you're borrowing, like Florida might be a higher risk than Minnesota or some other things. And so we have these adjustments also for property type, like a condo or a single family. And what they do is they take that base interest rate and they'll adjust it either up or down based on the lending criteria. Now, this is something that has been done since the very beginning of Fannie and Freddie lending on how they operate and what interest rate that you get. And historically speaking, you've always been able to have higher credit, higher down payment means better interest rate, and that's always been the case. Well, the Biden administration has decided as of lately to start May 1st, making different tweaks to those adjustments. So if you talk about your base rate, instead of having from your base rate, the higher credit score, higher down payment clients getting lower interest rates, unfortunately, those higher credit, higher down payment clients are getting higher interest rates than the lower credit, low down payment clients. Now, that cutoff, what they're saying right now is around 680. So that right at 680, above 680 is where you're kind of getting those higher interest rates or those increased loan level price adjustments, versus below 680 where you're getting the benefits or the credits for certain criteria, whereas it used to be flip-flop before. Now, this is something that they put out there since, January, February of this year. Like Chrissy said, I've been talking to realtors, clients, other people about these changes that are coming down the pipeline. So we feel like we are well prepared to help clients. One of the strategies that we can use when we talk about, kind of looking at these loan level price adjustments and what we can do to improve people's situations is talk about, if you have a higher credit score, we can talk about how to decrease your down payment to get a better interest rate, and then use some strategies to still help you avoid that mortgage insurance and, really overall structure your loan better. So in reality, is what the news and media is saying correct? Yes, it absolutely is. There are some, in price adjustments and things of that nature that are going to affect interest rate. Now, with that being said, when you take into consideration all these adjustments, we're talking about a 0.25% higher versus a 0.25% lower. We're not talking a huge spread here where it's a percentage point higher if you have an 800 credit score versus a 680. We are talking about small or minimal adjustments or the cost of that interest rate going up. So anytime that you are in the market and you have an interest rate that you want on your mortgage, there is a, what we call a base or the interest rate for your situation. You can choose to buy down that interest rate. In other words, pay a fee up front to achieve a lower interest rate, or you can do what's called buy up that interest rate, which means takes a higher interest rate to receive a credit towards closing costs on that mortgage. So you as a consumer do still have some of the decision-making power when it comes to what interest rate makes me feel comfortable. How do I want to structure this loan? We're here to help guide you through that. And it's just a matter of whether or not the cost of that rate is going to cost you more when compared to the same borrower with lower credit scores. So the reason for this is, and
this is what we're all
this is what we're here for. Yes,
because it doesn't make any sense to me.
Exactly, is the big outcry that everyone has had surrounding affordable housing. So as we all know, 2020, 2021, we saw historically low interest rates all the way down into the twos. We saw increase, historically high appreciation for properties that are in and around the area. What that did is it helped people at that time afford higher priced homes for less out of pocket with less interest paid to the banks. Well, what we're seeing moving into 2022 and then now into 2023 is because in order to curb inflation, that the Biden administration or the Fed has also increased those interest rates. What they're saying is that because of that increase in interest rates, the amount of homes somebody could afford is a lot less now. Well, the problem with that is there aren't any homes in that less affordable category because everything increased or appreciated in 2021 and 2020. And so what they're finding is trying to find ways to curb that, non-affordable section of the housing. In other words, saying, well, if our clients or borrowers need to buy homes and the homes are now priced $450 for a starter home, which is, usually pretty typical in Minnesota right now. If you really, there are obviously lower priced homes, but let's just say an average home of $450, they're saying, well, in order for that person that falls in that category of low income or needs affordable housing or something of that nature, in order to help them, we're going to help them lower the interest rate on conventional financing in order to help more people get into homes on that lower credit score, lower income, lower tax bracket situation. So that's where it's derived from. Okay. Unfortunately, what we're not seeing and what we have yet to see is how that affects the automated underwriting system. So a lot of information here. So we always run loans through an automated underwriting system that is put out by Fannie and Freddie. So if we run them through automated underwriting, that we can give confidence to Chrissy in the pre-approval for that client. And that automated underwriting, a lot of it is artificial intelligence. A lot of it looks at the standards for that person based on credit score, loan to value, credit, derogatories, collections, on-time payments, things of that nature. And it runs an algorithm and tells us the likelihood that they're going to pay back that mortgage. If it's likely, you'll get an approved. If it's not likely, you'll get what's called a refer. Well, normally when we have a client with 620 credit scores, 3% down, and which would be the most ideal situation, according to Fannie and Freddie, to get the lowest interest rate, those loans aren't getting approved through that automated underwriting system. So it's really not helping that buyer under that affordable housing like their intent is. However, I'm not saying that that automated underwriting system won't change, come May 1st as well, to allow for more of those borrowers to get approved.
Interesting.
Yeah.
Okay.
And we're talking conventional lending here. There are always alternatives for clients who can't get approved from that automated underwriting system to do FHA loans or something of that nature.
Okay.
And it's really the effort comes from that affordable housing, and how are they going to curb that? Now, in reality, is it helping? We have yet to see.
Right. So what this could be doing is just stirring the pot a little bit, getting everybody worked up, when in reality, how many people is this really going to negatively affect in a huge way? And how many people is it really going to change from an approval standpoint to get them into affordable housing? So
yeah,
we don't
it's
know.
Very true. We don't know. And the other, coupled with this, we can't forget about the lack of housing, housing available in general. And we all, and I know, Chrissy, you could speak to that and what's been causing that, lack of housing available. Some of the factors, could include, I don't know, people not wanting to pay higher interest rates. So if they're going to move, where are they going to move to?
Right.
What's that new payment going to look like? If they refinanced and are in that 2 to 3% range, they're saying, why would I ever move? Something like that. So we're kind of here to help navigate through that.
Yeah, there's definitely an inventory shortage. It's been ongoing. It's we have less inventory than even a year ago. But the reality is there are still people that need to move. There are still people that need to sell. There's life circumstances, so we navigate through those things as we need to. But we're here to answer the questions as they come, and hopefully this gave a reasonable explanation as to how we're going to navigate through this as far as rates go and the approvals go. I don't have additional questions on it. When people come at me with the questions, I say I work with a really awesome lender, and she is really great at explaining this to you.
Thank you. Yeah.
So I defer to the, I stay in my lane. I know enough. I know what I need to know, and I stay in my lane. And I refer those types of questions to my go-to lenders. So,
for me, just a couple of things to keep in mind when you're talking about this is it's always good to have a good strategy. Think about down payments, think about future actions, contact a lender like myself and Chrissy, and Chrissy as your realtor, so we can help you with that strategy, because that's what's going to be the most important. Second, it's really important to realize that interest rates are temporary. No matter what, whether you're in the 2s or in the 7s or whatever you're at right now, interest rates are temporary. There's always a strategy, again, that can be put forth into future lending. And if we really want to talk about, what's important when it comes to getting in that home, waiting to build equity in our, is never a good thing. So don't wait just because you're deterred by maybe a higher interest rate or maybe the things that are going on with Fannie and Freddie. There's always a way for us to put you into that home in a successful manner, have you comfortable with your payment, and start building that equity. That's what's most important. The cost of waiting is, huge in comparison to the higher interest rates that you're paying than what you're seeing. So I think those are just good things to keep in mind especially as the media tries to, talk through everything and make us feel fearful.
Right.
And that's really what this podcast is going to be about. Correct. Right. Addressing those fears and kind of just saying, like, what's really going on the home front.
Let's get down to the facts.
Let's get down to the facts. Yeah. And let's, just provide that good information.
Yeah. So thanks for tuning in. We would love it if you comment below and give us some ideas, things you want to hear about, topics. That'll help us come up with some better content for you moving forward. But we're hoping to do this on a weekly basis and have a lot of info to share. So
yes, and we'll have links to follow and subscribe below as well.
Absolutely. So that being said, I am good for the day.
Yeah,
It is
absolutely.
It's Monday. The sun is not shining, but we're gonna keep on
We're
keeping
hoping
on.
for the best.
Yes. So thanks for joining us, and we're super excited to just get to know some more people out there and answer more questions, and hopefully bring you value every time we come on. So thank you.
Awesome. Thanks, everyone.
Thanks, Nikki.
Yeah, thanks, Chrissy.
Yeah. Bye bye.